On this Opalesk virtual manager visit, we're going to Munich, Germany. We are visiting Quantumrock, an AI-driven investment technology asset manager. Founded in 2012, their aim was to develop a systematic scientific investment process to generate sustainable risk-adjusted returns for their proprietary trading activities. Now, experts in machine learning and artificial intelligence methodologies, their clients turn to them to provide them with a competitive edge in today's market. In this video, you will learn why Quantumrock applies a pure AI focus to asset management, details about Quantumrock's Volatility Special Opportunities Program, or VSOP, and you'll get to know Quantumrock's management and core team.
Hey Stefan, good to see you. Matthias, nice to see you. Welcome to our offices. Thank you so much. I'm now sitting down with Stefan Titel. He's the founder and CEO of Quantumrock. Later, we will be joined by Michael Seller, who is the Chief Investment Officer, and Dr. Roman Gorbanov, who is the Head of AI Systems. And later, Fabio Balloni, the CRO, will join as well. As a start, Stefan, please introduce Quantumrock to us as a tech asset manager. Quantumrock was founded 2012. It's already 8 years ago. And we started this company with a firm belief in today's environment where financial markets are changing much more frequently and also in ways which we have not seen before. We believe that only with the application of AI and machine learning technology in the future, asset managers will be able to really cope with those changes. And that's why we started with the development of an AI machine learning platform, which also separates us from what many other players out there in the market doing, because we try to industrialize the invention process of trading models, which of course is the core function of every hedge fund who is working on how to come to the next profitable trading model. And we try to solve it in a very scalable way. And as a matter of fact, we are, based on this, we are more a technology company in asset management than a pure asset management player applying a little bit of technology. It sounds like a fine distinction, but actually it is not. It's a big difference, as we see also in our case. Looking at our company history, we have created an investment product more than 4 years ago. It's traded since then very successfully in different market conditions and has accumulated an annual return of 18% on average per year. So what differentiates our approach from others? First to mention is the way we generate our trading models. It's a market truth that whatever trading model you apply, it will die out sooner or later. But while in the 70s, 80s, 90s, it took maybe 5 or even 10 years until the trading model died out, today it might take just a couple of weeks or a couple of months. And as a matter of fact, if you develop any trading model in the conventional way, so you have analysts, researchers doing their groundwork, their legwork to come up with a new trading idea, it might take them 12 to 18 months to generate one in this procedure. But in that time, the model is already obsolete again. In our case, the trading models are generated automatically by our platform. The platform is analyzing constantly, researching constantly the slightest market and price deviations in the given underlyings we are in, and is able, as of now, to generate around 1,000 models a month, new models a month, which are then assessed by our experts. So this gives us the capability or access to an almost infinite number of trading models. And in markets or in times where markets change so frequently, we believe this is the answer for continuous decent return. The second one is that we apply what we call dynamic models. Models, once they are in trading, are constantly measured against the markets and deviations in the markets, and their parameters are adapted to the current situation. Compared to a very static approach of a traditional hedge fund, this also allows you as an asset manager, as a hedge fund, to be able to generate returns in various market conditions when the markets go down and when the markets go up, or when the volatility shows a totally different a pattern which was never seen before. That what I describe work. We have shown not only over the past 4 years in various conditions, but especially in this year, COVID crisis, with volatility patterns never seen before like that. So we could pretty well perform in those flash crash scenarios. So where markets went down, volatility spiked, but we could also perform in the days or the weeks or months later when the markets recovered. And that is actually what we stand for, a very balanced investment approach whose investment and trading strategies are derived and generated on a scientific basis.
Michael, thank you for joining. Quantumrock's flagship strategy is the Volatility Special Opportunities Program, or VSOP in short. Tell us more about the strategy and what is so special about it.
So the VSOP strategy consists of two different portfolios. One is the beta portfolio that consists of duration and equity risk. And the other portfolio is a so-called crisis alpha strategy that tries to offset potential losses in the equity markets. So we combined those two strategies just to deliver an optimized Sharpe ratio in the overall portfolio. The crisis alpha strategies usually try to take long positions in the VIX future because the VIX future, of course, has a negative beta to the S&P market. It's able then most probably to compensate losses from the equity market. On the other hand, in the balanced portfolio, we have also duration risks. As everyone knows, duration is somehow negatively correlated to the equity market, and therefore we have another diversification component within the balanced portfolio. So we have developed different crisis alpha strategies. The reason why we developed crisis alpha strategies is, okay, of course, it fits very good to the balanced portfolio in terms of diversification. But the reality is much more that with our approach of machine learning, we were just able to detect some kind of inefficiencies or anomalies, much more likely in very volatile markets, in falling equity markets. So when the market is calm and goes steadily up, then most probably you will. It's quite hard then to detect any kind of inefficiency or anomaly, and that's why our strategies usually perform much better when the market becomes more volatile and equity market drops. So that means, of course, if you combine those two portfolios, you will have as a result you will have a steady uptrend in the strategy when the equity market goes up, and when the equity market takes a very sharp drop, you have good chances to compensate those losses, or maybe even to overcompensate the losses, so that you can make even a profit overall. And that's exactly what, for example, happened in the COVID crisis. And yes, and we are looking forward that we can just continue this kind of performance.
So Michael, in VSOP, you have two families of strategies. One is more beta-oriented, the other more crisis alpha. I wonder, how do you weigh or how do you allocate between those two families?
First of all, we try to target a volatility of around 10. So the beta portfolio contributes volatility of 7, and the alpha strategies contribute the same amount of volatility of also 7. The strategies are allocated in a way, of course, first in line we try to achieve a better Sharpe ratio. And on the other hand, we tried to get a kind of asymmetrical risk profile or return profile for the overall portfolio, so that an investor could maybe even offset his risks from different equity exposures by buying our product into his overall portfolio.
Michael, I wonder, from your perspective as the Chief Investment Officer, how is VSOP different from competitors and other volatility products out there?
So most of the common volatility products in the market are short volatility. So short volatility, as you might know, is of course strongly correlated with long equity exposure. That's why the usual volatility products do not diversify the equity risk too much. In our case, we have a different approach because our alpha crisis strategies that really go long the VIX future are made to offset losses coming from equity exposure. So that means that our positions in the VIX futures are negatively correlated to the equity markets and therefore give a very good diversification to equity portfolios. So I think that's one of the main differences versus the different or other products in the volatility space.
So Roman, thank you for joining us. Quantumrock uses machine learning for the research and the development of investment strategies. So why actually does Quantumrock use machine learning? What's the benefit?
Well, machine learning is a very advanced topic of artificial intelligence, and it has a history, a long history of development over many decades, and the whole field is about finding patterns and regularities in the data, and this is why machine learning is a perfect fit to financial problems if used properly. So once again, it's about finding patterns and regularities, and in the machine learning, we have a lot of tools and a lot of methods that help us to find these complex patterns. And these patterns can be very nonlinear, multidimensional, fuzzy, and this is why it's hard to find those patterns for human. So basically, with the help of machine learning, we can use data to search or to run an advanced search for those patterns. And overnight, for example, we can consider or validate over 1 billion of different patterns. And as a result, we find the patterns that are hard to find for a human. And as I have already mentioned, this can be very complex pattern with many parameters that depend on many variables and many features, and they're also fuzzy. Another kind of goal of machine learning is not only to find those patterns, but also to validate them. In other words, it might be the case that those patterns are present in the data just because of chance. So they are not real, they're just there because of randomness. And with the tools or with the methods of machine learning, we can find those patterns and verify them, in the sense that we can prove that those patterns are real and can be used in the future. So once again, it's about finding patterns regularity that can be used for construction of a trading strategy based on the data only.
So Roman, in the investment world, not everybody is convinced that AI can already be used really for signal generation. What is your view on that?
Yeah, it's a very valid question, because I would say that if you use machine learning as it is out of the box, it will not work, because finance or financial data are very special from machine learning point of view. One of the reasons for that is that markets are believed to be very efficient, and if they are 100% efficient, then we have only random walk in the data, we have only noise in the data. But we believe that on the market we have sometimes so-called inefficiency that we can utilize. And this means that we need to find useful signals in a lot of noise. So we believe that data is not just noise, there is some signals, but signals are very weak. And this is why we need to modify machine learning to our financial purposes. One of the modifications that we use is that we heavily rely on statistics to detect weak signals in a lot of noise, and also to verify the validity of these signals. And the second aspect of our tuning of machine learning for our purposes is that we do not generate prediction explicitly. For example, if you want to decide how much to buy or sell for tomorrow for a particular instrument, or in other words, we want to decide allocation for a particular instrument, we shouldn't necessarily have a prediction for tomorrow. Or in other words, if we have predictions for tomorrow, it's not trivial to decide an optimal allocation. This is why we have modified machine learning in such a way that we can calculate our allocation directly and evaluate those allocations directly. The third difference between vanilla machine learning and what we are doing is that we use time series as input for our models. Instead of using the vectors of fixed lengths with features, we use a time series of prices. And based on that input, we need to decide for the optimal allocation for, let's say, next period of time. And for that, we need to have a proper solution. One of the simplest solutions is to compress those time series into vectors of features, and then try to find a model that operates on those vectors of features. This is why we use machine learning on two different stages of modeling. On the first stage, we try to find the best way to compress time series into vector of features. And on the second stage, we try to find the best model to combine these features into a decision for the next period of time. Another thing that I would like to emphasize is that we put a lot of focus on the automation of the whole process. And the main idea behind that is that we want to have as many strategies as possible that are not really correlated with each other. Because if we have a portfolio of many uncorrelated strategies, the whole portfolio shows a good financial performance. And this is why from our side, we would like to have a system that helps us to generate the strategies as quick as possible, as efficient as possible. And this is what we call artificial intelligence systems. This is a system that is able to take data and then find patterns in this data, then validate those patterns and generate a working strategy that is already validated, and which has a lot of value in the context of the existing strategies.
So Fabio, thank you for joining. How can your risk management process be described?
So we use AI and machine learning as statistical tools, so statistical tool set to develop an actual strategy. And in that strategy development, we look for very simple strategies. So strategies that do not have a high trading frequency or a medium range frequency. And we look furthermore for highly liquid derivatives that we can trade, just to be sure that the output for that strategy is not that complex. So the work of the risk management here at Quantumrock consists of three major subjects. One is the data governance. The second one is the reporting governance, which includes the usual performance reports, positioning reports, internally and externally. And the third part is maybe one of the most important parts here, the strategy control governance, which is kind of a different approach that usual asset manager have. So we basically track the differences day by day between the backtest data and the real life performance. And for instance, what does evolve out of such a comparison is a real good a real estimate of the slippage that we have coming out of the strategy, which is obviously one of the crucial factors if a strategy is going to work at the end or not. And the risk management takes care of this number and publishes also this number. So as Michael for sure described, already we target our portfolio at a volatility of 10%. This obviously involves various models on which we are able to be sure that we are going to hit the 10%. So what we do in our risk management process is that we reproduce our backtest data on a daily basis. So the backtest data is obviously the foundation, the source to measure the risks that we currently have in the portfolio. And then we apply various gauge models. And these gauge models are calibrated in a way that we can measure the asymmetries in our distributions of our backtest series, and therefore can be more certain that we are going to hit the 10%. So to go a bit more into detail, the difficulties in calibrating these models obviously come out of the data. So how do you handle the data? As said, we reproduce the backtest data every day. So we have a fresh data set every day before the machine is calculating the risk model and therefore for instance, the value at risk. And what we then do is to be more even certain that we are able to hit the target volatility of 10%. We resample obviously the data. Here we use a block bootstrap technique, which is very efficient and very convenient regarding our data. And the combination out of gauge model and block bootstrapping gives us a high certainty to really meet that 10% of target volatility. But that's just one thing. So the other part obviously is like how you visualize this data. How do you make it really efficient for the employees, for the people that we have here. And obviously here, what is good for us, what makes it easy for us, we are all quants here. And therefore we can really visualize the data that comes out of the model and everybody understands it, what comes out of the model. So you have to think of a kind of dashboard that we refresh every morning. So everybody is able to track not only the performance and the positioning data, which is kind of standard, but also the model results. And therefore not only visualizing the value at risk, but also all the parameters that come off the model. As you might know, the gauge model is a fitting model, so you get also fitting results. How good is actually your calibration of the model and how good does it adapt to the market condition? And we visualize also this data. And portfolio management, risk management, and strategy development all have access to this data.
Stefan, how can clients invest into VSOP?
There are several ways. The first one is managed accounts on various platforms with various prime brokers. The second one is Deutsche Bank's dbSelect platform, the managed account platform, on which various hedge fund and alternative investment managers are listed, compliant and analyzed and everything. And we are the only AI player there and one of the top performers. It's also interesting for professional and institutional clients who want to make use of the leverage Deutsche Bank is providing. For instance, via investing in our strategy, the leverage offered by Deutsche Bank is 4 because our strategy is very well balanced. And lastly, we have a UCITS fund, tax optimized, state-of-the-art, compliant, also theoretically for retail investors, which can be used for all kinds of investors.
So Stefan, thank you very much. We talked about a lot today. We talked about what makes Quantumrock unique. We talked about your pure AI focus in asset management. We spoke about your VSOP strategy, got to know your team. So thank you so much for your time today.
Thank you so much. It was a real pleasure. And the discussion was good for both sides. I also want to underline that we are open for inquiries from interested investors. They can come here, visit us, discuss with our experts, have a look under the hood, so to speak. But of course, we can also arrange for Zoom calls, whatever is needed.